Good afternoon and welcome everybody. Today we're going to be looking at corporate bonds, an investment class which traditionally has been rather inaccessible to retail investors. Fortunately, the combination of technology and platforms such as WiseAlpha are changing this. I'm joined today by Anil Kumar and George Flynn. Anil manages the WiseAlpha community and is responsible for building a positive and influential group of investment enthusiasts. George is Managing Director at Everest Research, a deep dive independent high yield research firm and owner of European High Yield Online. So without further ado, I'll hand over to the experts. Over to you, Anil.
You're on mute.
Anil, you just need to turn off mute. Sorry.
that would be a good start. Thanks, James, for the kind introduction, I was saying, and thank you, Master Investor, for having us on board today. As James mentioned, my name's Anil. I'm joined here today with George. George, want to say a bit about yourself?
Yeah, as James said, I'm a Managing Director at Everest Research. We're a deep dive research firm focusing on high yield and credit distressed situations. I also own European High Yield Online, which is a website hoping to build a community of guys interested in European high yield.
That's brilliant. Thank you, George. I'm just going to share my screen now. We've got a presentation here planned for you. So like I said, the purpose of today is we're going to give a brief overview of corporate bonds and the main points that you should know about them. So first, we'll kick things off with what is a bond? Well, in short, a bond is a debt, and it's a contract between an investor and a company. So a company will borrow money from an investor, and in return, the investor will receive regular interest payments from the company with the expectation that they will receive the full investment back at an agreed date. Now, let's take a look at a case study here. So let's have a look at Netflix. We all go to Netflix for our TV shows, for our films. Netflix is currently the world leader in the online entertainment industry by revenue. So in 2019, if we have a look at the example I mentioned, Netflix attempted to raise 1.1 billion euros from investors. And a question that we want to ask a lot here with debt investing is why. So why did they do this? Well, for example, in 2020, the estimated production budget of The Crown, which is the show about Queen Elizabeth II, it was reported to be around $260 million, which makes it one of the most expensive television series in history. Therefore, Netflix issued a corporate bond worth 1.1 billion euros. And again, we want to know why. So why would Netflix even attempt to raise this kind of money in the first place? Well, the benefits that Netflix received from producing its planned content include financial growth, which can be used to repay the debts, and also potential record-breaking streaming statistics. And these two reasons give investors an explanation for the debt that Netflix is issuing. And it's also known as the use of proceeds. And if it's a good use of proceeds, then the investor will happily lend Netflix 1.1 billion euros. And remember, we want to know why here. So why would an investor lend 1.1 billion euros of their own money? Well, the answer is simple. Netflix has incentivized the investment, and Netflix has told investors that they will fully repay the billion euros back in 10 years' time. Therefore, 2029 is known as the maturity date. So by 2029, so by the maturity date, Netflix would have hopefully generated enough cash from shows like The Crown that they're able to repay the 1.1 billion euros by maturity. And if they can't do this, well, Netflix could just borrow the money from someone else, i.e. they could just issue another corporate bond to refinance the existing debt. Now, if this happens, the cycle that you see on your screen now will just start that again. So Netflix will issue a corporate bond. Netflix will give reasons for issuing the debt, and the debt investor can find this in the use of proceeds. And if it's a good use of proceeds, then the investor can invest their money. Okay? Now, how will the investor make money if they're lending their own money? Well, until 2029, Netflix will offer regular interest payments to the investors. And in the bond world, an interest payment is known as a coupon payment. And this coupon payment or interest rate is dependent on many factors, such as how stable the company is, how well the industry is doing, or even the economic climate. And again, we want to know why. So why has Netflix offered to pay regular interest payments? And well, there's two reasons. And the first one is so Netflix can borrow the money that they need. And the second one If so, an investor can receive a return on their investment. So it's a win-win situation for both parties. Okay, now we're going to add some numbers in, and these are completely they're not real numbers as well. Netflix can offer to pay the coupons annually, so once a year, semi-annually, so twice a year, or quarterly, so 4 times a year. In this example, Netflix offers to pay a 5% coupon on a semi-annual basis with a maturity date of 2029. So in other words, Netflix offers to pay an interest rate of 2.5% every 6 months for the next 10 years. Now, if we have a look at each year to see the transactions that happen each year, in year 1, an investor will lend Netflix €1 billion. So there'll be €1 billion will be leaving them, and they'll also receive their first 2 coupon payments of €25 million each as well. So in the first year, they'll receive €50 million. Now in years 2, 3, 4, 5, 6, 7, 8, and 9, the investor will continue to receive their 2 coupon payments of €25 million each. And finally, in year 10, the investor will receive their final 2 coupon payments of €25 million each, as well as their initial €1 billion investment from Netflix. So to clarify, the investors would have received in total €1.5 billion, and this is a €500 million increase in their initial investment, which calculates to an incredible return of 50% over 10 years, which is a very, very attractive investment opportunity for the financial elite. So that's just a brief overview of what corporate bonds are. Now we'll have a look at the main differences between bonds and equities, as this is a topic of discussion that is often debated. For example, which one is a better investment opportunity and how should you invest in each one? Well, me personally, an easy way for me to think about this is to see a company's shareholders as its owners and the company's bondholders as people that it has borrowed money from. Technically speaking, shareholders are just borrowing money from bondholders. And unlike bonds, equities offer less clarity about future returns just because they don't have any coupon payment dates where you have an expectation of your capital being returned, as is the case with bonds. Equity managers also have no obligation to pay dividends as well, as there's no promise that your capital will be returned at a particular maturity date. They do also hold similar characteristics in the sense that the price of bonds can go up and they can go down. However, equities are more volatile than bonds, which means that their prices vary more. Bonds also have a higher claim in the capital structure of a company as well compared to equity. This means that if a company defaults, bondholders are amongst the first people to receive their money back. Now, the bond market and the stock market, how similar are they? Well, this chart plots the returns of key indices used by the industry to access the performance of equities, investment-grade corporate bonds, and high-yield corporate bonds. As you can see, high-yield corporate bonds have outperformed UK equities and investment-grade corporate bonds over the last 20 years, both in terms of returns and price volatility. Now, the question I'm sure you're all wondering, which one should you invest in? Well, the answer to this question honestly does just depend on your personal circumstances, but in short, you should try invest in both. There's several benefits to investing in both equities and bonds as part of a diversified portfolio. They both have similar characteristics, and so both can be extremely valuable when trying to create a well-diversified portfolio. It is just important to be aware of the risks involved in both and to seek advice if you are unsure about anything. Now, we're going to move on to why we're here today, and that is to educate the masses. So from executive directors to university students, WiseAlpha wants to bridge the knowledge gap and educate the masses about corporate bonds. Now I'm going to pass over to George, who will talk more about the corporate bond market and give a bit of history into it.
Thanks, Anil. So, as you mentioned, corporate bonds are less well-known asset class, but they're certainly very important to the overall financial system, and corporates being able to raise money to invest in various projects and grow their business. As of 2020, the European high-yield corporate bond market was around 508 billion. That's a growth rate of 370% over the last 10 years. So it started off relatively late compared to the US high-yield bond market, but it's growing very quickly, and it's quite an exciting place to be at the moment because there's lots of sort of new issuers coming to the market for the first time.
Thank you. And how much is the whole market worth at the moment?
So the whole sort of global high yield market's worth about 3 trillion. So dollar high yield, so US based companies and dollar denominated high yield bonds, that's roughly 50% of that. So the US high yield market started in sort of the 1980s, and it took almost sort of 2 decades for Europe and the UK to kind of start in the high yield market. Now, the European market's roughly about 18% of the global market, so nearly a fifth. And whilst it's relatively small, you know, you look at the growth rates of the European and the UK high yield markets since 1999, it's sort of a compound average growth rate for around 25% for the European market and around 12% for the sterling market. So not only have the markets been growing, but you're seeing increased diversity within the market. That's in the form of companies that are issuing, the industries that they're issuing from. It's also in terms of the rating spectrum, and in terms of the use of proceeds, and just, I guess, broadly in terms of the, you know, across industries as well.
Thank you. And you mentioned there, obviously, over the past 20 years, the annualized growth has just been increasing. What do you think the key growth driver of this has been?
So I'd say globalization has a large part to play. Globalization has seen European and UK companies look to expand in Asia and the US, and with that, you know, they've looked to raise money to fund that expansion. Similarly, you've got US and Asian companies looking to do business in Europe and the UK and looking to issue debt in those currencies so that they can fund their operations there. So I'd say globalization is a big driver, and then there are other drivers such as the life cycle of the company, where it is, whether it's a startup or whether it's an aging company. Also, whether it's an LBO, leveraged buyout, and is backed by private equity. And also we're seeing some move from leveraged loans, which is another asset class, but more private debt, to high yield bonds, which is obviously public debt. So there's a number of things, but the main one is globalization.
Thank you, George. And one thing that you briefly touched upon there is the accessibility of bonds. They're actually quite difficult to access, and there's usually a minimum contribution of £100,000 to actually invest in a corporate bond, which makes it impossible to invest in for the majority of the population. However, what this graph shows you is that although wealth determines access, all wealth levels actually underinvest in bonds. And we believe that investor education on corporate bonds is extremely limited. For example, investors with up to £5 million have limited or no access to the corporate bond market. And we strongly believe that educating people about corporate bonds is key to building trust within the trillion-dollar industry.
Yeah, I'd say building trust is important, and the best way to do that is through developing sort of knowledge around the asset class. So now we can talk about the WiseAlpha Bond Academy. So I guess the first thing to say is the Bond Academy is free. It's CPD accredited, and it looks to educate investors about the corporate bond market. It consists of easy to follow units, and the idea is to give people the tools and sort of make them aware of the questions and approaches to thinking about investing in corporate debt, give them the confidence so that they can kind of look at corporate bonds as an investment. As an asset class, corporate bonds have flown under the radar a bit compared to equity, but when you actually look at sort of the risk return and the volatility, they actually offer an interesting risk return profile, and therefore you know, I think as an asset class it really is something worth looking at. And now with WiseAlpha and the fractional bond platform, you know, there's a way for sort of the man on the street to access that.
Exactly, Georgia. And you mentioned it, the Bond Academy was just born out of the desire to take corporate bonds from the misunderstood to the mainstream. many investors have just never considered corporate bonds just because they've got little understanding of them, or they're just unaware that they are accessible at all without having a substantial figure to invest with. And we wanted to provide a free educational series for those who were interested in learning about corporate bonds. And we wanted to ensure that it assumed no prior knowledge as well, so you could start completely from the ground up. So from the basics of what corporate bonds actually are, as you can see here from Unit 1A, to a more detailed look at how to determine a company's commercial viability. The courses cover everything needed for users to get to grips with the market. And George, I just wondered if you could just tell us a bit more about yourself now and how you came to the decision to actually develop the Bond Academy.
Yeah, so quickly on myself, I've got 15 years experience in credit. I've been a portfolio analyst, a trader, traded everything from investment grade, high yield, sterling, dollars, euros, the credit indices, credit default swaps. I'm also a senior credit analyst. And in terms of why the Bond Academy, the fractionalized bond product and being able to access the bond market is a pretty big thing in my mind. And given the lack of knowledge around the asset class, it certainly makes sense to put together a Bond Academy and teach people sort of an approach or ways to think about credit investing.
Thanks. Well, let me be the first to congratulate you on such a good job. Obviously, our customers are happy. Here are just a few testimonies of people who have enjoyed using our Bond Academy. But not only this, we're using the Bond Academy to produce other content as well, just in case you don't find this form of learning useful. So, for example, we've started a podcast series, which can be found on all major streaming services, with Spotify, Apple Podcasts, Google Podcasts, for example. If you want to educate yourselves about bonds by listening to someone with a Birmingham accent, then honestly, there's just nowhere better for you to look on that one. We've also produced an educational blog series as well, just in case you prefer this form of learning as well. I think, George, it just highlights our motivation here to bridge the knowledge gap that we mentioned earlier. But now we have come to the end of our presentation, and we have some questions from our audience, I believe. Prior to this webinar, we did ask our attendees to send through any questions that they may want answered, and we've had quite a few, so I'll start here. George, I'll start by asking you, is it possible that the Bond Academy is simple to you as an expert investor, but may still be rather complicated to a rookie?
No, I think sort of as an expert investor or someone who's a bit further down the road is more honest, I think. But basically, when you have some expertise and you have knowledge, you have the ability to break things down into sort of simpler building blocks. And so that's the approach we took, was basically, take our knowledge and try and explain it as easily as possible, block by block. And it's done at a pace that the user can kind of take their time. It's free, so there's no kind of cost, and then it's also accredited. So you can actually take those CPD accreditation and stick it on your CV or put it towards your CFA hours during the year.
Thank you. And you mentioned you've got 15 years of experience working within credit analysis. So what if we've got a couple of attendees here that are like yourself, they're already seasoned veterans. Is the Bond Academy still going to be useful to them?
I hope so. I mean, I think if you are, if you're doing, bond investing day to day, then there's probably not a ton of stuff there for you. I mean, hopefully there's a couple of things you think, oh, okay, that's interesting, or I hadn't thought about it that way. But if you're sort of looking at completely different markets, then it should be a nice sort of introduction into how do I think about corporate bonds. Also, throughout the course, what we do is we have reference to sort of outside sources, so it's also a way to kind of discover what are some good books, what are some good articles, what are some good websites that are going to tell me about corporate bond investing. So yeah, I think from that perspective, it's pretty straightforward.
Thank you. We may have already covered this one, but I'll ask you anyway. What triggered the development of the Bond Academy?
I think it's mainly out of taking corporate bonds, high yields out of the shadows, if you like, making it a bit more accessible to everyone, and sort of explaining what the market is and explaining how it works. It's slightly more, that there's different aspects to think about, but what we're trying to do with the course is sort of add units and continually allow for people to kind of develop their knowledge, and the idea is you start completely from ground zero and you can work your way up, and the plan is to add on additional units, and if there are things on the course that aren't making sense for people, then they can always reach out, but the idea is to really sort of explain 101 what the corporate bond market is, what does the structure look like, why does it exist, who invests in it typically, what are the motivations, how do I think about investment.
Thank you. And I guess just to add to that point, over the past year with the pandemic, it's given an unexpected surge in free time and working from home, flexible working from home conditions. A lot of people have seen this as a perfect time to learn new skills and just brush up on pre-existing knowledge, and we expect this growth trend to actually continue, and we want the Bond Academy to be the go-to resource for both those who are considering starting their investment journey and those who have actually already begun it. Just another question here, George. How can an investor determine the strengths and weaknesses of a company when deciding to invest?
Okay, I'd say as a credit investor, that the most important thing is, am I going to get my money back, essentially, and am I getting my interest paid? So what you really want to do is you want to look at the ability of the company to be able to generate cash flow. So cash is king. So it's all about cash flow, liquidity. So basically, where can they get money from? What are the conditions for them to have access to that money? Then also sort of asset coverage. So how valuable is the company? How valuable is the company's assets? What's kind of the loan to value that there is within that company? So there are a number of factors, and we go through them in Unit 3 of the Bond Academy. But for me, it's cash flow, liquidity, asset coverage are the most important. And then, from there you can basically go through each of the financial statements, and there are various ratios that you can look at. So leverage, for instance, or interest coverage. So how much does earnings cover my interest? And there are various versions of that. Free cash flow. There's a lot of different metrics, and what we try and do is go through the ones that we think are the most important.
Thank you. So cash flow and earnings, liquidity sources, ratios, just a couple things here to assess when determining the strengths and weaknesses of a company. Do you have any other top investment tips for our attendees, George?
Yeah, I mean, first off, I'd say is all sort of investments and investors are different, right? So you have to kind of think about things within your personal kind of circumstances and what you want to achieve with an investment. I think from my side, it's really about sort of understanding what you're doing, and if you're looking at a company, then you should be able to kind of explain to someone else what that company does, how it earns its money, how much debt it has, how you expect it to pay off its debt. So you need to be able to kind of give some kind of explanation. If you can't sort of answer those questions yourself, then you're probably in a bit of trouble. I think WiseAlpha have three kind of key general rules. They're starting small, keep it simple, which I think is very important, and then also think about compound interest and sort of how those coupons come back to you, and on what you need to do them in terms of investment. And then, yeah, I think people generally want guidance, and when they're hearing about corporate bonds for the first time. And again, I think the sort of CPD accredited course is a great way to kind of dip your toe in and learn a bit more.
Thank you. And you mentioned the Bond Academy is, of course, it's a CPD accredited. There's 5 units on there currently, and each unit holds 1 hour of CPD accredited activity. So are bonds not too complex to simply be understood in just a 5-hour course?
No, not at all. I think every investment is different, but there's no kind of time frame in which you have to complete it. Each unit has got some answers, a quiz at the end, where you can kind of test your knowledge. And the idea is you test yourself, progress, and what ultimately the aim is to give people the confidence to sort of say, yeah, I understand what a corporate bond is, I understand what the high yield market is, I understand how to think about credit fundamentals. So the idea is to basically step by step build up that knowledge, but it's free, so there's no kind of time limit either, so you just sort of do it at your own pace.
Exactly, that's a good point to mention. Just another question here. Despite your offer of education, aren't corporate bonds still really only accessible to wealthy investors?
Well, not anymore. Through WiseAlphas fractional bonds. But I mean, the aim of the Bond Academy is to make people aware of corporate bonds as a market, how they work, and to be able to sort of think about them as an investment and how they might fit in your portfolio. So it very much is a case of kind of trying to help democratize an asset class, which I think is very important.
That's brilliant. Thank you, George. And we're just getting some Q&As now from our attendees, so thank you for sending through your questions. George, I'll start off with this one. Can corporate bonds be used as margin in an options trading account?
Yeah, I mean that's quite tempting. I think the answer is it really depends on who your account is with. It also depends on what their rules are for collateral. Obviously, corporate bonds are less liquid than cash, and they have a price, so the price moves up and down, so the collateral that you've got there is going to change in value as well. And then there are also maybe some rules around the kind of bonds you can post, so the structure of the bonds, that maybe they have to be plain structures, highly rated. So there's a number of factors. So the answer is you should be able to, but it's going to be very dependent on who you have your account with. And I wouldn't be surprised that you're having to post more collateral than you'd be if you're posting cash.
Thank you. And a couple of questions have come through about ETFs, so I'll read a few of them to you. You can answer them in one. Are there any ETFs or investment trusts that use different types of corporate bonds and therefore allow a spread of investment? And also, what are the pros and cons of investing bonds through an ETF compared to investing directly?
Okay, so I would say ETFs obviously are a broad investment vehicle, so they allowed you to basically invest in generally a market. So that could be euro corporate bonds, investment grade, or high yield, or sterling, or dollars. It could be emerging markets. You have some ETFs that are based on special bonds. So there's corporate hybrids, and then you've also got some ETFs that focus on financials. You have ETFs that have leverage in there as well. ETFs that look at corporate default swaps, which are essentially based off of credit risk. So there's a wide variety of ETFs, but generally when you're buying an ETF, you're buying a market, and if you're buying a market, you are essentially passive investing. So that means if there are losses due to defaults or the yield is relatively low, you're going to get paid what the market is paying you. Also, you have no real discretion over what's being invested. There are now ETFs with sort of an ESG flavor, focusing on ESG, but compared to active management, active management is about selecting sort of the opportunities from the market to come up with a return that meets a given aim of a portfolio or investment aim that you have. So it might be you have an investment horizon of a year. It might be that you want to earn more than more in terms of the market, or you're willing to take more risk than the market. It might be that you believe a particular sector is going to do really, really well, and you want to kind of be overweight that sector. So it's really, active management is more about sort of taking a view on the market as a whole, and then using different segments, overweight, underweight, single names, and using that to drive your returns. So realistically, there's quite a big difference between the two.
Thank you. Another one here. I've seen over the past few months, or just lost that. I've seen over the past few months that third parties advertising bonds of Lloyd's Banking Group, GSK, etc. at 5 or 6% or more. Are these true or scammers? And how do I know if a bond issue is real or scam?
Okay. So what I would say is yield is proportional to risk, and so the higher the yield, the higher the risk. At 5 or 6% in the current market, that's probably saying that there's some risk there. Those two names that you mentioned are generally highly rated. So for them to be offering that much is not impossible, because what you can have is either longer dated bonds, so very long dated bonds. And again, if I'm lending you money today and I expect to get it back tomorrow, that's less of a big deal. But if I'm lending you money and I want it, the term I'm lending to you is over 30 years, there's a lot more uncertainty. So you need to get a lot more yield to offset the risk. So it could be that they're very long in maturity, or it could be that they're relatively subordinated within the capital structure. By that I mean the bonds themselves are designed to sit between sort of equity, which in a kind of default situation would be the first loss, and then you also have some subordinated debt, which could then help absorb loss or potentially conserve cash flow. So you have some types of bonds that will essentially turn off their coupons, so they don't pay interest when the company's in distress. So it could be that there's some kind of subordination there, and therefore you're getting paid a high rate of interest or yield because there's additional risk. But without sort of knowing what the ones are, wouldn't be able to say. Now, saying that, what you can do is you can take the ISIN or the identifier, and you can go on the Irish Stock Exchange, the London Stock Exchange. You can go on Orb, which is for retail bonds. You can go on Hargreaves Lansdown, and you can basically look up the ISIN, and you can look at the bond price, etc. On the exchange. And then the other thing I would say is, these companies will have an IR department as well. So you can always just drop them a line and just, you can ask that. But if someone is pitching an idea to you, they should be providing all of the, the identifier, etc., so that you can go away and have a look.
Thank you. Question here. I'd like to better understand why yields go up when bond prices fall and vice versa. I feel like you may have kind of all just covered that, but before you do answer that question, we've actually got a blog post that actually answers this specific question, and it's called "Why Do Bonds Move in Price?" So I think that if you visit our website wisealpha.com/blogs, you'll be able to get that answered for you, George.
Okay, so I mean, the simplest way to think about it is if we go back to that Netflix example, which was purely fictional, and just assume that on day one, you've got Netflix paying 5%, and then you've got the market that pays 5%. So if I'm an investor, I could buy the market at 5%, or I could buy my Netflix bond at 5%. So on the day the Netflix issues, it's paying the same yield as the market, and I basically will have a par price of 100%. Then the next day, if you assume that the the yield drops to 4%. Now, the market's yielding 4%, but my Netflix bond has a coupon stream of 5%, so I'm earning 5% on that. So to basically make the bond yield 4%, the same as the market, so that basically there's no kind of real difference in choice between Netflix and the market, Netflix's price will raise, and the increase in the price is equal to basically the spread. So I'm spreading that additional price across my coupons and reducing the coupon amount effectively by paying upfront. So basically what you're doing is you're charging the person upfront, and that results in sort of a 4% yield. Okay, so basically again you're at 4%. So you're paying a higher price, and in paying a higher price, effectively you're reducing the overall return. And then in terms of a yields going up, so let's say yields go up 2% the next day, so the market's now 6%, my Netflix bond is 5%. Now, if someone wants to buy my bond, they're going to want to earn 6%, not 5%. So the way that they earn 6% is by me offering a discount to par to 100%, so it'd be less than 100. And that discounted amount effectively increases my return over the time of the bond. And so you get this this relationship, this inverse relationship between yield and price.
Thank you, George. What are the advantages? Sorry, wrong question. What is the difference between investment high grade bonds and high yield bonds?
So the market, the corporate bond market, is split investment grade versus high yield. Investment grade bonds are anything rated above and including BBB minus as a rating agency. So there's a rating spectrum. It goes from AAA and it goes all the way down to BBB minus. And these companies tend to be massive multinational. They'll be listed. They'll generally be global, and they will have a huge, a strong credit profile. Okay, so a credit profile with lots of cash generation, and maybe they pay that cash out to dividends, or maybe they invest that cash into capex. And then you have high yield, which is slightly more risky, or is more risky, and that goes from BB plus all the way to CCC minus, or actually goes down to D for default. So you have a much higher risk spectrum. So these companies will tend to be smaller than investment grade companies. They can still be listed, they can still be global, they can still sort of have large capital structures. You can think of cable operators, these kind of guys. They have strong sort of cash flow generation, and then as you move down the rating scale, you will get companies that are either smaller in size, they might be new, they might be companies that have been around for a while and have been downgraded. They may be companies that are being brought to the market via leverage buyout, and so they were investment grade, but now they've got additional debt, and they're part of a leverage buyout, so the private equity is using debt to buy the company out. So what you have is you have kind of like an exponential scale when it comes to defaults and ratings. So basically the probability of default will rise exponentially as you move further and further into high yield. So they're two very sort of separate markets. In terms of high yield bonds themselves, there will be a lot more sort of documentation. There's generally sort of called covenants, that say what the company can and can't do, what they have to do. So there's some, there's additional sort of investor protection put around those lendings, and then you'll also have, security over the assets. You can have secured bonds which have security, and then unsecured, which are obviously a bit more risky. Investment grade issues tend to be, fully unsecured. But for high yield issuers, investors want to have, a line of sight generally on, assets, and be able to say, if something goes wrong, what am I going to get back?
Thank you. Another question here. Is there a ranking structure for types of corporate bonds from less to high risk?
Yes, generally, the way to think about it, if you start at the bottom with equity, so the way to think about it is kind of like a tower. So you have equity as the first kind of loss piece. So if anything goes wrong, equity will absorb the losses. Then you will have unsecured or subordinated debt. Now, unsecured debt is typically a high yield bond without the security, or you can have it structured so that there are various attributes to the debt, so that it basically absorbs loss either at the same time as the equity, or maybe slightly ahead of the equity. Maybe it turns off the coupon stream. These generally are called corporate hybrids. So you have this kind of quasi-hybrid debt. Then you have the unsecured debt. Then you'll have your secured debt, which typically is kind of bonds. You'll also have loan debt in there, and then you have super senior secured, which is kind of like revolving credit facilities, basically FX reserves, these kind of things. So there is a pecking order, and part of investing in high yield is understanding, that pecking order and where you sit within it.
Thank you, George. Just a couple of questions have come through here about the cost of the Bond Academy. A lot of people have mentioned that it's free, which is good to see. I'm just going to have a look here. Is tax deducted at source, or do you have to declare it annually to HMRC?
You have to declare it.
Thank you. How easy is it to deal in bonds in both buying and selling? Are these operations done like with shares on the spot?
In the market generally, you'll find, and I'm talking about sort of the institutional bond market, I'm not going to talk about WiseAlpha's market specifically here, but basically in a bond market, you will have certain levels of liquidity. Now, liquidity in the bond market is going to be less than it is in the equity market, just because the size of the markets. But generally, there's a bid-ask spread, and that bid-ask spread is proportional to the quality, the credit quality. So basically, if it's a high-quality bond, I wouldn't expect there to be a large difference between buying and selling. An investment grade, that can be basis points, hundreds of a percent. When you move into high yield and you move into sort of the more distressed side of things, the bid offer will widen. So at the high end of high yield, again, the bid offer is relatively small, and then as you move to more risky situations, the bid offer and the liquidity sort of increases. And when you're looking at something like a particularly distressed situation, the number of people who will participate in that, for instance, decreases significantly to the performing credit market. So sometimes stuff can trade by appointment, but generally the high market is relatively liquid. But in times of stress, or with a particular name, if there's news about a particular name you can get volatile price moves. So it's not as liquid as the equity market, but it's certainly investment grade, very liquid, and in sort of the high grade, or the high end of high yield, it's pretty liquid. But then as soon as you start moving down the rating spectrum and start moving towards special situations, those things can trade biaccordingly.
Thank you. An interesting question just come through here as well, and we may have touched upon this earlier. Neil's kindly asked here, he's mentioned crypto, for example, and how there's a lot of talk around it at the moment due to media, for example. The question is it an educational issue or a media or PR problem for the sector when competing with industries like crypto?
I think it's historically been quite sort of, it's just the size of the initial investment is so large for you to make, and you are looking at markets that are relative, not super new, but like I said, they're constantly growing, right? And I think it's the market is growing, and it's growing relatively quickly. But in terms of who's able to access it, I think that's the main driver, and that level of awareness is there. I mean, if you look at pension funds or you look at sort of institutional investors, all of these guys will be aware. They all use bonds in their portfolio, they all use high yield in their portfolio, they all use leverage loans, etc. So they use all of these instruments, but the guy on the street will just be buying their product. So he hasn't really had access to or the opportunity to be aware of this. It kind of sits behind institutional sort of fund managers generally. So I think it's more the industry itself, and the fact that it's beginning to open up is a positive thing, and I would expect that to increase. I also would say that there's a lot more regulation sort of around, say, corporate bonds, and you need to make sure people are aware of what they're doing, and this kind of thing. So straight off the bat, the number of people who could invest in a corporate bond is initially lower if they're doing it through the just on their own. And whereas crypto, you could set up an account in sort of 10 minutes and trade, and there's no real oversight. So I think it's very much sort of an established market, and it's just a question of making people more aware of it.
Thank you. And just one final question that's coming through here. How would a small investor, for example, with funds under 100K, invest in the bond market?
I mean, I think what you can, if you're sort of with 100,000, I mean, what you can do is you can, and again, I'm not giving investment advice, but you can look at basically fund ranges. So you could look at existing funds that are out there. You could look at, for active management, where you're going to get charged X%, and you can kind of decide if there's a particular theme or there's a particular asset class, euro, sterling, dollar, high yield, investment grade, ESG, whatever. Is it short term? I'm looking to earn something over a year, or am I looking to earn something over 5 years, or even longer? Am I looking to earn something over 30 years, and I just want to put something away and forget about it? So there are funds where you can do that. There are ETFs which offer you very cheap, but essentially you're buying into the market as a passive investment. And then there are also the platforms like WiseAlpha and others, or Orb, where you can kind of make investments. But WiseAlpha probably offers where you can make relatively small investments and get some diversification. But again, if you're doing that, you're going to have to understand each investment that you're making. So there's various options, and I guess it comes down to, one, what you want to achieve with the portfolio. What's your return target? Two, your level of experience, and how you think about the markets in general. and 3, your ability to kind of take the time to understand investment. So I think there are a lot of options, sort of from the very passive to the very active, and it's up to the investor and their situation to kind of try and come up with how they want to achieve their goal.
Thank you, George. And we should probably mention the website that you need to visit if you want to get access to the Bond Academy. It is learn.wisealpha.com. So I'm glad that I plugged that one in there at the last minute. We do seem to have come to the end of our live Q&A session. It doesn't look like there's any more questions that have come through. Again, the Master Investor have just kindly put the website address there for the Bond Academy. But yeah, that just about does just wrap it up for today's webinar. Thank you to George for joining, and we'll pass over to you.
Thanks, guys. That was a really interesting discussion, and it's obviously definitely an area where investors, they should be more aware of, given the income-starved world that we currently live in. So yeah, thanks, guys. I'd like to draw viewers' attention to our upcoming events, which you can see on the slides at the moment. Don't forget, you can keep up to date with everything by signing up to our mailing list at masterinvestor.co.uk. And please do complete our user survey after today's event so we can continue to improve our services. Yeah, so I'd just like to thank Anil and George for their time today, and I'm sure we'll be seeing more of you in the future. And also thank you all for viewing. So see you next time.
Thank you.
Thank you.
Thank you.